Hi everyone, Rick here. I hope you're doing great today because I have some great news for you. At the end of March 2023, the Schwab U.S. Dividend Equity ETF, ticker SCHD, went under a so-called annual reconstitution. Basically, a process in which some stocks of the ETF get thrown out and some new ones get included. Now, although in the investing community there has been a concern that the changes in SCHD didn't actually account for the recent banking crisis, which is partially true, I do believe that we are still in a great moment to buy this ETF, and probably this is actually the perfect moment. We are going to discuss the good and the bad of the annual reconstitution of SCHD, and we'll take a closer look at the current valuation and what happened in the past few months. And since I want to be as fair as possible, I'm also going to show you the downsides of it, because honestly, there are some. Alright, before getting into the main part of the video, I actually want to address one important thing first. My goal as an investor has always been to attain the best results in the long term, obviously. And in my experience, finance and investing are one of the things that are best kept simple. If you spend countless hours analyzing hundreds of ETFs and investing in many of them, eventually you're not going to have a better return in the long term. In fact, most likely, you're going to ruin it. There are literally hundreds of different ETFs that constantly try to beat the market and constantly fail to beat it in the long term. Some of them try through the so-called call option strategies, like SVOL or JP, which perform well only in bear markets. Some give incredibly high dividend yields, which in the end are just a dividend trap. And some are actively managed and eat out most of your earnings over time. Now, you can go crazy or gamble as much as you want, but if you want to achieve the best results in the long term, truth is, there is no better way than keeping your portfolio simple and investing in broadly diversified ETFs like SCHD if you like dividends, or the S&P 500. Now, let me be more practical. SCHD grew with an average of 12.09% in the last 10 years, and this even considering that since May 2021, the ETF basically flattened like the S&P 500 because of the crisis. So I took the time to create a table that shows you how much you need to save and invest every month if you want to become a millionaire by the age of retirement if you invested in SCHD with an average return of 12%. Of course, past performances are not a guarantee of future results, but I'm not expecting SCHD to perform under an average of 9-10% in the long-term future. What you can notice right away is that you actually don't need so much savings in order to retire a millionaire. And the younger you are, the easier it's gonna get. For example, if you're between 20 and 30 years old right now, you're gonna need to invest between $37 and $59 per month until the age of retirement, which, come on, it's just peanuts. If you start investing later in life, the amount grows. But to be honest, except if you start after you're 50, it's still gonna be pretty easy. This incredible growth comes from the compounding of the returns that you get when you hold an investment over a long period of time. It's the greatest asset of an investor, and it's the reason why choosing a broad ETF, which covers a good part of the market and manages to keep a constant return around 10%, is way better than trying to find ETFs or stocks that make 20% return. Because most likely, in the long term, you're gonna achieve much less than that. Alright, let's move on now to the reasons why I believe that we're in a good moment for buying SCHD. At the end of March 2023, SCHD completed its annual reconstitution, which is, as I said, a process in which the stocks included in an ETF get rebalanced. This year, a total of 25 companies were added and 24 were removed. The biggest election was IBM, which was completely kicked out, but before thinking this is a bad thing, let's see how SCHD chooses its stocks. SCHD tracks the Dow Jones U.S. Dividend 100 Index, selecting 100 U.S. securities excluding REITs. The index is built entirely by an algorithm without any human decision. So, how does this algorithm decide which stocks to pick? First of all the stocks are screened using these three criteria. They need to have minimum 10 consecutive years of dividend payments, minimum 500 million float adjusted market capitalization, and minimum 2 million or 3-month average daily trading volume. All the stocks that match these requirements are then ranked by dividend yield. And this is the reason why mega cap tech companies like Apple or Microsoft never qualified for this ETF. Now, the final decision of which stocks will be finally selected happens based on 4 factors: the average dividend growth over the past 5 years, the free cash flow to total debt, the return on equity, and the expected forward yield. This is the new chart that shows the percentage holdings in each sector in SCHD's portfolio before and after its reconstitution. And it's very clear that the exposure to the financial and tech sectors have been reduced by a lot. Information technology dropped from 22.53% to 16.78%, and financials from 18.90% to 13.90%. On the other hand, healthcare had the highest increase, going from 11.15% to 16.52%, and energy followed, going from 5.17% to 8.96%. I have to add though that I believe that the drop in information technology was caused mostly by the sector price drop, and not really because tech companies have been eliminated, but we'll see that later. The index removed 24 holdings, including International Business Machines, IBM, Cummins, CMI, and Prudential Financials, PRU. IBM is a technology company that produces and sells hardware and software. Cummins is an energy manufacturer, and Prudential Financial is a global financial service company that provides insurance, and in 2019 this company was the largest insurance provider in the US with $1.35 trillion of total assets under management. The reason why these companies were dropped lies in their fundamentals. IBM's free cash flow per share fell from 11.19 to 9.38, while Cummins dropped from 10.53 to 7.39. Essentially, this means that these companies have less capacity to increase dividends at a higher rate, which is SCHD key investment objective. Here's again the list of the companies that were deleted from SCHD's portfolio, and you can notice that quite a few of them are financial stocks. However, it's important to note that excluding the top 3, the remaining 21 had a combined weighting of 5.92%. Now, the index also added 25 securities, and this chart shows all of them sorted in order of market cap with total returns of each stock in 2022. The key additions were AbbVie, a biopharmaceutical company, Chevron Corporation, an oil and gas company, and UPS, a logistics company. Looking at the total returns, AbbVie gained 24.04% and Chevron 58.48% last year, and they boosted their quarterly dividend yields by 4.96% and 6.44%. The good thing is that these dividend yields are pretty high, but also sustainable. AbbVie's free cash flow per share in 2022 was $13.69 compared to $12.49 in 2021, with an increase of 10.23%. Chevron instead increased its free cash flow per share from $11.03 to $19.49, which is an incredible 76.70% jump. In case you don't know, the free cash flow per share indicates how much cash the company generated relative to the number of shares outstanding, and it's used to evaluate the company's ability to generate cash. Now I want to show you something. This chart shows the result of the SCHD's new 2023 portfolio back-tested from 2017 compared to the previous portfolio composition of the same ETF and to the S&P 500 through the SPY ETF. As you can see, the new portfolio would have outperformed the previous SCHD and SPY by an annualized 1.25% and 1.48%, with a better overall performance from 2021 to 2023. An investment of $10,000 in SCHD's 2023 portfolio would yield $21,335, outperforming the old version and the S&P 500 by almost $2,000. So this shows that although many of the new additions to SCHD's holdings have suffered significant price drops, the success key are the fundamentals that the index uses to evaluate companies that it decides to invest in. And this is why the profitability rating of this ETF is extremely high, and after the Reconstitution went from 9.34 to 9.53 out of 10. Now, this other chart shows the annual return of SCHD's 2023 portfolio compared to the previous portfolio and to SPY. This chart is more relevant to investors focused on dividend income because it shows the annual portfolio income of an initial $10,000 investment if all dividends were reinvested. As you can see, the portfolio income of the new SCHD would have grown from $324 in 2017 to $769 in 2022. That is an almost 19% 5-year growth rate, which beats the ETF's growth rate of 17.44%. Now, what do we know about the future of this ETF? Well, past performance is never an indication of future performance, but considering the backtesting, it's done pretty well so far. And the additions make it a solid ETF that will keep solid dividend yields in the future. Right now, SCHD is providing a 3.77% dividend yield, which is amazing, and has a 5 years beta of 0.89, which basically, being under 1, means that the ETF has low volatility and has an estimated 5.32% earnings growth rate. Alright, the second reason why I believe that this might be a good moment to buy this ETF is the poor performance of the last months and the reason behind it. This year, SCHD has significantly underperformed the S&P 500, as you can see from this graph, and this happened primarily due to its previous exposure to the tech and financial sector. You probably know about the collapse of the Silicon Valley Bank on March 8, 2023, and of the Signature Bank later in the same month. And these recent failures of the banking system have impacted the whole financial sector and to a lesser extent also the technology sector. The financial and technology sectors made up 18.9% and 22.5% of SCHD's portfolio at the end of December 22, making SCHD underperform the S&P 500. But it's also true that even though in the short term this is not a positive period for the banking system, in the long term the strong drop in prices in the financial sector puts us in a more favorable position to buy into this sector. Besides this, the exposure to the financial sector is much lower now, so the ETF Reconstitution of March 2023 actually put us in a better position to buy now. Same goes for the technology sector. If you only think short term, you might be afraid of what's going to happen in the next months. But for the long term, you need to consider that this sector has been going down since the beginning of 2022, and we are now in a phase of recovery that will likely put us in a good earning position in the next years. There are also some potential downsides to the changes of SCHD, and they're related to the key additions, which were AbbVie, Chevron, and UPS. Starting with UPS, according to various sources, SCHD has now a lower earnings momentum because of the poor recent earnings results from UPS and Texas Instruments. So adding UPS could slow down its dividend growth rate in the future and might not be the best outcome for dividend investors. The second downside comes from Chevron. The oil and gas sector boomed in the last years because of the global energy crisis, but it's not sustainable in the long term. Chevron in particular had a total growth of 58% all in 2022, making it a potentially overvalued company. Still, oil and gas only covers 3.9% of the total SCHD's portfolio, and I expect Chevron to be able to pay extremely good dividends in the future because the high energy prices are not coming back to the values of 2020 anytime soon. The last downside is related to AbbVie. Their main product is a drug to treat autoimmune diseases called Humira, that in 2022 accounted for 37% of the total revenue. The threat here comes from a cheaper copycat of Humira that has been developed and released in February 2023 by Amgen, another big pharmaceutical company. Because of this, AbbVie expects a 37% drop in Humira sales this year. Now, while this might look like a really dangerous threat, the positive side is that in SCHD, Amgen is basically the same weight as AbbVie. So whatever drop in price is going to affect AbbVie in the short term because of the competition with Amgen is going to positively reflect on Amgen, balancing the portfolio and minimizing the volatility. So I hope you enjoyed this video, everyone. Thank you so much for watching, and don't forget to subscribe to the channel. I wish you a great day or evening, and as always, I'll see you in the next video. Ciao!